Yeah, good evening, everyone, and welcome to tonight's webinar. And I'm sure you are ready to explore with me how to use the MT4, how to use the MT4. So fantastic! I'll be walking you through how to use the MT4, and I'm glad you joined me last week and you are here this week. So again, I would like to know where you are watching me from. From which part of the world, and from which state in Nigeria are you watching me from? This is very important. From which state in Nigeria are you watching me from? I would like to know. So just let me know in the comment section where are you watching me from, and let's connect together. Let's connect together. I want to know where you're watching me from so we can connect together. Okay, so today we're looking at how to use the MT4. This is a more practical course, a more practical session, and I want you guys to pay attention, right? Okay, so if you have any question, you can just drop it in the comment section, so I flow along. Don't forget to tell me where you are from. Okay, I'm with Caroline from Port Harcourt, Nigeria, Alami from Kaduna, Danielle from South Africa, Omstar Skid from Sokoto, Nigeria. We have Phyllis from it's okay. So I'm in Nigeria, in Vietnam. Awesome. Okay, we have Donald from Ado-Ekiti, Nigeria. Then fantastic. Okay, good to have you guys on the show this evening, and as we proceed into exploring the MT4, right now, the MT4, I'm going to walk us through what we call the timeline. But before we go through the MT4 now, I want you to understand what the time frame is all about. Now the question is, what is a time frame? Now, from the word time, then frame, right? From the word time and frame, you understand that time is, like you're trying to monitor, you're trying to track a particular, you're trying to track the how do I put it now? You're trying to track the difference between an hour to 2 hours, 1 hour to 4 hours, 30 minutes to 5 minutes. You're looking at time. Now, frame now has to do with the distance. So now, time frame is that you're referring to the designated unit of time in which trading takes place. So in Forex, time frame is the designated unit of time in which trading takes place. So from what you can see here, we have the 1 seconds, we have the 5 seconds, the 15 seconds, we have 30 seconds, we have 1 minute, 3 minutes, 5 minutes, 15 minutes, 30 minutes, 45 minutes, 1 hour, 2 hours, 3 hours, 4 hours, 1 day, 1 week, 1 month. Right now, so we are looking at the designated unit of time in which a trading takes place. Now, typically, Forex time frame we are measured in units, hours, days, weeks, months, and then you can choose which time frame suits you. Now, we would go into a practical soon, looking at the MT4. So the next one, we'll look at trends in Forex. So now, a trend is a tendency for prices to move in a particular direction over a period of time. A trend is a tendency for prices to move in a particular direction over a period of time. Now, from the word trend, so when there is a trend, they say this is the trend going on now. This is how we dress now. This is how we dress now. This is how we dress in the 21st century. That's the trend. You get that? That's the current activity going on. So like the world is moving in a particular direction. You say, oh no, now we can't do like this now. This is the trend. Let's go with the trend. Like let's go with what is the latest direction, the latest path people are following, the trend. So now bringing it down to Forex now, we're looking at the path at which prices have been moving consistently over a period of time. So now the trend can either be upward. So we say, oh, the price has been going upward consistently in an uptrend. So let's follow the trend. Just like you follow your fashion trend because it is the latest and current activity are happening now. You can, in Forex, you also want to follow the price in the direction at which it is going. Right? Now, the downtrend, like when the price is moving downward, is trending downward, then we have horizontal and wave-like trends. Right? Now, we've looked at time frame. We're having an overview on trends. Then let's look at indicators. Now, we have what we call indicators. Okay. Now, have you ever wanted to cross the road and you have a what's it called? A traffic light. Now, the traffic light indicates red, telling the drivers to wait, right? Now, why those who wants to cross the road can cross the road, right? Or why other buses or cars can go through another direction, why the ones coming from the right would have to wait, right? Now that traffic light is an indicator. An indicator giving a instruction, right? Indicating that the drivers from the left should wait for the drivers on the right to pass, and also for passers-by to cross the road. Right now, so indicators in technical analysis are tools created for Forex traders. Now, in a simple language, custom Forex indicators are mathematical formulas that allow traders to identify what the market trends are, that is currently, and to use them as this concept to carry out their operation. So now this market trends like the MACD, the moving average, the money flow index, the one balance volume, we have the Bollinger Band, among many others like that. So now these indicators gives signals to when a particular action is taking place in the market or about to take place, right? Because we have the leading indicators. These are indicators that will tell you what is about to happen, like what is going to happen. Then we have the lagging indicators that only show you what is happening now. Do you get it now? So we're going to explore those ones. We're going to explore the time frame now. We'll look at the trend. Then we'll look at indicators. Now let's talk about support and resistance before we dive into the chart and have a look into them one before the other. Now, support occurs when price falls and stop. Now let's use this as an example here. Right now, you can look at this place here. Let me pick my yep, okay, fantastic. Now you see price coming down from this level here, right? Then price came here, went up a bit, right? Now price came to this level and then went up. Now this level at which price was rejected to the upside, this level is called the support level, right? Because it's just like now price is falling. When I throw something at you, okay, let me use someone as an example. Mohammed from Kogi. When I throw a ball at you, right, and you use your hand to catch the ball. Now, if you had not used your hand to catch the ball, what do you think could have happened to the ball? The ball would have touched you and fall down, right, without anything to hold it back up. But because you use your hand to catch the ball now, you've supported the ball from falling down. That's support. Support is coming down, so you support it. It should not fall. So like when I throw an egg at you, then you don't want the egg to fall, you just support it with your hand. That's support, right? Now, resistance on the other hand is when prices has risen up to a level, higher, and then stops before changing direction. Now you look at this place. Now I said when price falls down to this level and was rejected, this level is what is a support level, right? Now, but when price now starts going up and touches this level, right, and this top level now rejected it down, what happened? This level becomes what? A resistance level. So imagine you are behind a door, right, or you are in the room and I'm outside the room. I want to force the door open on you, and you are pushing, you are resisting me. Now that's what is happening at that resistance level. Is that level where price gets to and is being resisted. Right now, I want to assume that you are in a room, right? Now, if you look up and you throw your pen or a ball or something up, like you throw it up in a hard way, now you know that it will touch the ceiling and fall down. Why? Why is it going to touch the ceiling and fall down? Because the ceiling is a resistance. It's stopping it from continuing upward, right? That's your ceiling will stop either my pen or your book or the ball from continuing upward to resist it back. That's assume that as resistance. That's what's happening here. You threw a pen up the ceiling and then it was resisted at this level, right? So now you see this place is what? Support level, and this place is what? Resistance level. Okay, more of it in our practical session while we jump on the chart. Now let's go practical. Okay, so great. Now today this is our MT4, right? Now let's take it one before the other. In our first session we talked about the time frame. Now this is MT4. This is the region for time frame. Can you see it? Time frame. And let's go to now. Currently you can see that I'm on Euro USD now, and I'm on 4 hours, the 4 hours time frame. The 4 hours time frame. Now this is the daily time frame. So let's come from the 1 minute. This M1 is 1 minute, right? So you can see that in this 1 minute time frame, for each of these candle, each of these candle are formed in 1 minute. That's after 60 seconds. Each of these candles are formed after 60 seconds. This red candle where my arrow is now is formed in 60 seconds, right? This one is formed in 60 seconds. This one too is formed in 60 seconds. 60 seconds, they said, makes what? 1 minute. So in a 1 minute time frame, this candle is formed in 60 seconds. Each candle is formed in 60 seconds in 1 minute. Now, this is M5. As you can see, what it shows there, 5 minutes. So if I go to M5, each candle on this 5 minute time frame is formed in 5 minutes. So this candle here now, it took 5 minutes for this candle to be formed. It took 5 minutes for this to be formed. It took 5 minutes for every candle on this chart to be formed. Do you get that now? So there are persons who trade this 5 minute time frame. We call them the lower time frame. Then the 15 minute also, each candle on this 15 minutes is formed. Each candle on this chart is formed in 15 minutes. This is a 15 minute time frame, right? Okay. Then this is M30. This is that each candle on this chart is formed in 30 minutes. Each candle on this chart is formed in 30 minutes. This is H1. Each candle on this chart is formed in 1 hour. So it took 1 hour for each of these to be formed. It took 1 hour for each of these candles to be formed. There. So how many minutes make 1 hour? 60 minutes. So it took 60 minutes for these candles to be formed. Then we have H4, which is 4 hours. Now it took 4 hours for this candle to be formed, right? Each of these candle, it took them 4 hours. So this one that is currently forming now, it will take 4 hours for it to be formed, right? So in the D1, which is the daily time frame, it took 24 hours for each of these candles to be formed. That's the daily candle. It's 24 hours for each of these candles to be formed. Now, the W1 is 1 week weekly candle. It took 7 days, so 5 days for these candles to be formed. Monday to Friday, each of these candles took 5 days to be formed. The weekly candle. Now, the monthly candle, it took it took like 30 days, 31 days for each of these candles to be formed. Each of these candles to be formed took 31 days for each of these candles to be formed. Now, this is the time frame. Now, this time frame now determine the time frame you decide to use. Now, determine the kind of trader you are. Are you a long-term trader or a short-term trader? Right? Are you a day trader, a position trader, an intraday trader, or a sniper, as people call it? So some persons who use the 1 minute time frame are looking at the short term profit, where they want to just come into the market and in the next 1 minute they're out, or the 5 minutes too, they want to come in and look at in the next 15 minutes they're out. Same thing with 15-minute time frame. So the kind of time frame you are using also determines a lot into what kind of trader you are, what kind of opportunity you are looking to open. So the moment you are now looking at the 4 hours, the daily, the weekly, the monthly time frame, it means you are looking at the long term, right? You are reasoning, okay, let me open a trade and see if I can hold it for 24 hours and make some profit and like that. So that is it. So now that's all about the time frame, right? Okay. Now the next in line is the trends in Forex. The trends. Now I said we have uptrend, we have downtrend, right? Now this is what kind of trend is this on Euro USD 4 hours? What kind of trend is this? Look at where I map out this thing. I went to go and take this thing called draw the trend line. So I use it to draw this trend line. Like, okay, come in. Okay, cool. Okay, cool. So it's our trend line. I'm trying to so now from this chart that you are seeing now, what comes to mind? What kind of trend is this? Is this an uptrend or a downtrend? Let me see who is going to answer me. Who is going to tell me what market trend is this? What market trend is this? I just explained to us in our slide. What market trend is this? Is this an uptrend or a downtrend or a wave like trend or something? Who is answering me? I want to believe you are following. This is an interactive session. Let me know in the comment section. I'm very much interested. Okay, Elizabeth said downtrend. Fantastic. It's a downtrend, right? It's a downtrend, practically a downtrend. Okay, awesome. Okay, awesome. Let's look at do we have okay. So what trend is this? I So what trend does this appear to be? So great. That's an uptrend, right? Your ability to identify the current market dimension has solved a part of your problem, right? Or let me say your challenge of spotting out the profitable market, right? So you want to understand: am I in a downtrend, or are we in an uptrend, or are we in no trend? We don't even know the direction where the market is going. So because of course the market can decide to just be migma rolling, in a range. Let me see if I can spot out something. Okay, to see where the market is just giving us a range like movement. Let me see if I can spot it out in some other places. Okay, cool. Look at this place now. Okay. Yeah, you look at this place now. You see what the market is, what the market did here at this level here, right? Yeah, I want us to see. Fantastic. Okay, cool. Can you see what I did there? Now, from here, you'll be able to spot this. This is a daily time frame. So for days, the market of Australian dollar, Japanese yen, it was just ranging within this triangle. Before it now broke out below. Right? It broke out to the downward direction. So but for days, because this is daily time frame, so each of these candles here were formed in days, one day. So now it took days. The market was just ranging in this spot. No specific direction of are we up or are we down, right? So the market just decided to go on a range, just consolidating within that box. So at this moment, you don't know the direction of the market. You might decide to stay out of the market or stay away from this trend until it creates a new direction, until the market finds a good direction. Then you want to position yourself in that direction, right? Let me know in the comment section if you understand, if you get what I'm saying now. If you understand very well what I've explained, let me know in the comment section. Say understood. Let me know in the comment section so I know you are following me and you are getting the best from this. So we've looked into time frame, we've looked into trend lines. Okay, let's have a quick jump on the next one, which is indicators. Then last one is support and resistance. So let's go straight now. For indicators, you want to go to the insert. Then you see what we have here. We have indicators. Then at the point we have indicators, we have accelerator, oscillator. We have accumulative distribution. We have alligator. We have average directional movement index. We have average true range. We have awesome oscillator. Then we have trend. We have the indicator. These indicators monitor the trend. We have the average directional movement. We have the Bollinger Band. We have envelopes. We have Ashimoku. We have moving average. We have parabolic SAR. We have standard deviation. Then for you go to insert indicators. Then we look at oscillators. We have average true range, bear power, bull power, commodity channel index, relative strength index, relative vigor index, stochastics, so many of them. But I'll just unpick few of them and then we look at one or two things about them. Let's look at the relative price index. That should be sorry, relative strength index and stochastics. All right. Now let me just explain this too, and I had one more. Now, if you look at let's start with the relative strength index now. Now, if you see the relative strength index within this place, let me remove this one so that some persons don't say I'm confused because they are saying the okay now cool. So I have only the relative strength index here. Now, the relative strength index measures the strength of the market. If are we having are the bulls having more strength, or are the bears having more strength? So this indicators now this indicator, relative strength index, measures the relative strength index of the market. Is the bull more strengthened or the bear more strengthened? Now, how do they measure them? If you look within the range of this relative strength index, you will see a thin line. Look at this thin line, right? This thin line goes straight to this number called 70, right? Where this vertical scale is popping up. Then this second line below goes towards 30, where this vertical scale is showing up, right? Now, the moment this blue line goes up towards this 70, right, it's indicating that the market is overbought. Like the market is already at a buying side, the market is already at the high side where it is now overbought, right? The price is overbought, then which means that people might want to start selling, right? Now, and as you can see here, when it gets to that region, it drops, which shows that at the overbought region, people sold off here and it dropped down to this place. So the relative price index, strength index rather, measures the strength of the market. So now, if the market is going towards this number 30, this line of 30, now it shows that the market is in a bear movement, right? So all through from this place down to this place, the market is in a bear movement. Once it touches this line and crosses this line, the market is already oversold, which means it might pick up from that place, right? It might pick up from that place. So this 70 region and this 30 region are used to measure overbought and oversold region, right? Good. Now let me remove this and show us that of stochastics. Okay, great. Now, almost similar case appeals to stochastic too, right? Now, because if you look at stochastic, we have this vertical scale. At this vertical scale, you see 80, right? And then at this place, you see 20. Now, this is used to measure if the market is at an overbought region and also an oversold region. Now, if the market crosses to 80, right, it shows that the market is at overbought region, right? If the market crosses down to 20, it shows that it has oversold region. You should start buying. If it gets to overbought region, it shows that overbought region, you should start selling off, right? So now this is an indicator. It gives you a signal of when the market is overbought and when the market is oversold. Okay, cool. Okay, now let's look at one other one before we move to support and resistance. Parabolics. Now, if you look at the let me remove this okay, I mean, oh my god, I'm sure you can spot some lines and some dots. Can you spot some dots on the screen? Can you spot some dots on the screen? Some dots. Those are parabolics, sir. Those are parabolics, sir. Those are parabolics, sir. Sometimes parabolic sir is mixed with moving average. Let me see if I can get a moving average here. They are used to track the trend line. Okay, let's use moving average 21. Okay, exponential. Okay, cool. Now, so a moving average. I'm sorry, a moving average. Now, you can use a two moving average. I want to explain this parabolic SAR now. Now, you see this parabolic SAR. It's you also used to indicate when the market is in a uptrend or in a downtrend, right? When the market is in an uptrend or in a downtrend. So as you can see here, if the parabolic SAR appears above, let me use this as an example. So look at this place now. If the parabolic SAR appears above a candle, right, it shows the next move of the market. It shows the next move of the market. Look at this candle. Look at this place now. The parabolic SAR appeared above this candle here, indicating that the market is going down. If it appears below, right, it indicates that the market is going up. So the kind of parabolic SAR also gives signal of a bull or a bear market movement. I don't know if you catch that. So the parabolic SAR also give explanation into a bull market or a bear market. So when a parabolic SAR appears above a candle, if the candle is in a bullish movement like this, and a parabolic SAR appears above one of the candles, it shows that market is about to change direction, right? If it's in a bearish movement and parabolic SAR appears below, right, it shows that it's about to change direction to the upside. I don't know if I'm communicating. Okay, fantastic. Okay, fantastic. All right, now, so you can use the moving average too. Now, let me remove the parabolic SAR, and sometimes some persons use two moving average. One, let me use 5. So we have 21 and 5. Okay, cool. Let me give it a different color so that we can spot which is which. Okay, now, so this one here is the yellow one is the 21-day moving average. 21-day moving average. Why the red one is the 5-day moving average. The 21-day moving average, which is the yellow one now, tracks the movement of price from the last 21 days, right? The 21-day moving average tracks the movement of price from the last 21 days. While the red line, which is the 5-day moving average, tracks the movement of price from the last 5 days, from the past 5 days, right? So 5 days each from the past, it tracks it to see how market has been moving, also in order to predict the future. You get? So it uses what has happened to look at what is happening to predict what could happen, right? The past, the present, and the future. That's one thing you can use moving average for. Now, if the bigger moving average, if the 21-day moving average crosses above the 5-day moving average. Look at this place here now. Look at the 21-day moving average. The yellow one is above the 5-day moving average. It shows a bearish movement, right? It shows a bearish movement. If the 21-day moving average is above the 5-day moving average, it shows a bearish movement. So at this point here, where the market crosses themselves, let me show you here. Now at this point here, where the 21-day moving average cross above the 5-day moving average, a trader wants to look at selling off. You get selling off at this level because the 21-day moving average has crossed over the 5-day moving average. It indicates a bearish momentum coming in. Then if you look at this place too, now you see that the 5-day moving average was crossed above the 21-day moving average, indicating what an uptrend, right? And you can see what the market did. So these are the different ways via which these indicators are being used, right? Are being used, and you can decide to explore them more and use them the more. If you are using your laptop, just go through this insert, then you see indicators, and then you can pick up any of those indicators there. Now let's look at support and resistance. Support and resistance. Now, from my previous explanation, right? From my previous explanation, look at this level here. Is it a support or a resistance? This level here, is it a support or a resistance? Let me know in the comment section. Let me know in the comment section. Is this level a support or resistance level? Now let me know in the comment section, is that a support level or a resistance level? Is it a support level or a resistance level? Awesome. Resistance level. This is a resistance level, right? Fantastic. Now this level where price has gotten and was rejected twice, this level where price has gotten and rejected twice is called what? Let me this level here where price got to and was rejected, what level is this? Who can tell me? This level here where price got to and was rejected, yes, support level. Fantastic. Support level. So now it's clear that you are able to identify which level is resistance and which level is support. So you can easily know that, okay, if price gets to a very high peak and has been rejected consistently, like now you look at this place, price came here and it was rejected, it came to that same level, it was rejected, what do? You want to sell off because it will most likely keep going down, you get, at a resistance level. And look at it at a support level too. It would, once it gets rejected and price comes to that same level, you want to buy because there's higher chances that it will be rejected and it will go in your direction. So that is support and resistance level. So we'll bring today's webinar to a close. I would like to take one or two questions. So if you have a question, just drop them in the comment section before we round up today. So if you have your question, let me know in the comment section. I'll just answer one or two questions and we call it a day and meet you next week. Drop your question in the comment section. Oh, there is. Yeah, someone said, which is the best indicator? Which is the best indicator? There is no best indicator, right? There is no best indicator. Do you get that now? There is no best indicator. What no indicator specifically is the, how do I put it now, is the euro. Now you have to work with what you are used to, right? What you've developed, what you can work with. So some persons work with the moving average, why some work with the parabolics are, right? Now why some work with the what's it called, the Bollinger Band, right? And then you just choose what works for you. You get, and how you can know what works for you is after you back test them. You back test them on your demo account before testing them on your real account, right? So you now know which one is good for you and which one is not. All right. So thank you very much for attending to this webinar. We'll be drawing it to a close. I look forward to seeing you next week. And that webinar is coming up. You don't want to miss it. We are giving you exclusive educative content. All right. Thank you for showing up today. See you next week.